Most people think investing is for people who already have money. They imagine someone in a suit, sitting in front of multiple screens, watching charts move in real time. And because that image feels so far from their own life, they decide investing is not for them. Not yet. Maybe someday, when they have more money, more knowledge, more time. But here is the truth that nobody tells you at the beginning. The people sitting in front of those screens are not the ones building the most wealth. The people building the most wealth are usually doing something far less exciting, something so simple it almost sounds boring. And that simplicity is exactly why it works. So if you have ever felt like investing is too complicated, too risky, or just not something you understand, this video is for you. Not because I'm going to make it sound easy, but because I'm going to show you that the first steps are genuinely simpler than you think, and that starting badly is almost always better than not starting at all. Let's begin with the most important question. Why invest at all? And the honest answer is this: because not investing is also a financial decision, and it's usually not a good one. Every year, inflation reduces the value of money that sits still. The cost of groceries, rent, healthcare, everything you need, it goes up. And if your money is sitting in a regular account earning almost nothing, you are slowly losing ground, even when you feel like you're standing still. Investing is not about getting rich quick. It's about making sure your money at least keeps up with the world, and ideally, grows beyond it. Now, the second thing you need to understand before anything else is risk. Because risk is the word that stops most beginners before they even start. They hear it and they think, I could lose everything. And yes, in theory, with certain types of investments, that is possible. But the kind of investing we're talking about here is not that. We're talking about putting money into broad, diversified funds that represent thousands of companies across the economy. The real risk in investing is not understanding the difference between short-term and long-term. In the short term, markets go up and down constantly. A bad month, a bad year, these happen regularly, and they are completely normal. People who panic and sell during these moments turn temporary losses into permanent ones. But people who stay invested, who treat their investment like a tree they planted, those people almost always come out ahead. History shows that markets, taken over long periods of time, have always recovered and continue to grow. Not every individual company, but the market as a whole, every single time. So, how do you actually start? Step 1 is simple. Open an investment account. In most countries, this is easier than opening a bank account. You download an app, verify your identity, and you're in. The most common types are brokerage accounts and retirement accounts. If your country or employer offers a tax-advantaged retirement account, that is almost always the best place to start, because you get a tax benefit on top of the investment growth. But even a simple brokerage account works. The important thing is that the money is somewhere it can grow. Open the account. That single action puts you ahead of most people.
Step 2 is deciding what to invest in. And here is where most beginners get overwhelmed, because the options seem endless. Stocks, bonds, ETFs, index funds, mutual funds, crypto, commodities, the list goes on. And my honest advice is to ignore almost all of it at the beginning. Because for someone just starting out, one type of investment has consistently outperformed almost everything else over the long term: a broad market index fund. An index fund is essentially a basket that holds a small piece of hundreds or thousands of companies at once. When you buy into an index fund, you're not betting on one company doing well. You're betting on the economy as a whole doing well over time. The fees are low, the diversification is built in. You don't need to research individual companies or time the market. You just put money in and let time do the work. Now, here's something that surprises a lot of people. You don't need a lot of money to start. In fact, many platforms allow you to begin with as little as $10 or $20. The amount matters far less than the habit. Because the most powerful force in investing is not how much you put in on day one. It's how consistently you put in over time. This is called dollar cost averaging, putting in a fixed amount on a regular schedule, regardless of whether the market is up or down. Some months you buy when prices are high, some months when prices are low. And over time, it averages out into a solid foundation. Consistent, automatic, boring, effective.
Let's talk about something concrete. Imagine you invest just $100 a month starting today. Nothing dramatic, just $100 automatically transferred every month into a broad index fund. At a historical average return of around 8 to 10% per year, in 20 years, that $100 a month becomes somewhere between $50,000 and $70,000. Not because you did anything clever, not because you picked the right stock or timed the market, just because you started, you stayed consistent, and you let time and compounding do their work. And this is the part that most people miss. Compounding means your returns earn returns. In year 1, you earn on what you put in. In year 20, the growth is happening on a much larger base than you ever contributed yourself. It starts invisible and slow, and then, suddenly, it's not. This is why starting early, even with a tiny amount, is worth so much more than waiting to start big. There is one more thing I want to address, because it comes up every single time someone starts investing. And that is the temptation to do something more exciting. You will see someone post about a stock that went up 500%. You will hear about a cryptocurrency that made someone rich overnight. You will feel like your boring index fund is leaving money on the table. And some of those stories are true. Some people do get those returns. What you don't hear about are the people who lost most of their money trying to find the next big thing. For every person who got rich on a single stock, there are dozens who lost everything trying the same approach. The math of losses is brutal. If you lose 50% of your investment, you need 100% gain just to get back to where you started. And that is why professional fund managers, people who do this full time with access to the best research and tools in the world, still fail to consistently beat a simple index fund over the long term. Not sometimes, almost always.
So here is the summary of everything we covered. Serious. Invest. Because not investing is also a choice, and inflation makes it a bad one. Understand that long-term risk is very different from short-term volatility. Start with a broad index fund. Simple, low cost, diversified. Put in a fixed amount every month, regardless of what the market is doing. And then leave it alone. Check in once a year. Resist the urge to react to news. And remember, the goal is not excitement. The goal is freedom. Financial freedom. The kind that comes slowly, quietly, and then all at once. The best time to start was 10 years ago. The second best time is today. Not when you have more money, not when you understand more. Today, with whatever you have. Because every month you wait is a month of compounding you never get back.